We need like a little intro video where it's like, the Anthony and Sal Show! Hello, hello, hello!
Good morning.
And welcome again to what they did not teach you in school. This is actually episode number 11. 11 straight weeks we've been doing this every Wednesday morning. We got Sal Longo and yours truly here. Today we're going to be talking about Bitcoin. Should you invest in it? Should you not invest in it? We're going to talk about a new study that McKinsey, a consulting firm, came out with about how millennials are screwed for retirement. We're also going to be talking about the difference between a tax-free savings account and an RRSP, because apparently my own team members don't even know what the difference is. And we're going to be talking about the biggest myths when it comes to taxes in Canada and how you can actually make 10 to 50% on your money without any risk just by using the tax code to your advantage. Bitcoin. Anthony, should I invest in Bitcoin? How many people reach out to you on a weekly basis to ask about Bitcoin?
A lot of clients, a lot of people that have invested in it, bought in it, they're asking on a regular basis.
Yeah. Okay, so it reminds me of a story that me and Sal talk about all the time, and it's actually a story that people use a lot to describe when they should pull out of an investment, when real investors pull out of the investment. The story goes as so. Rothschild, who was one of the most richest people to ever live in the world, he was in the concourse of Wall Street with his business partner, and they were getting their shoes shined. And the shoe shine boy said, "Excuse me, sir, can I give you a stock tip? Would you like a stock tip?" And of course, he didn't know who Rothschild was and that he was an investor that invested in the stock market. Rothschild humored him and said, "Yeah, sure, what's the stock tip?" He said, "X railroad company." Rothschild and his business partner went back up to their office and told all of their stockbrokers to trade that stock right away.
Meaning to sell it because they already owned it prior to the shoe shining.
Exactly. And what that says is that is when the average person wants to make that kind of investment, that's when it's probably too late and you should be taking your money out.
So people are asking, how does this apply to Bitcoin?
Yeah.
Well, Bitcoin, the masses now are starting to pose a lot of interest into it. A lot of people, average investors, retail average Joes are buying Bitcoin. And the question is that a good thing for investors who own it? And just like Rothschild that applied almost 100 years ago, now the answer is probably not. You're probably looking at a bubble, because the average person's buying it, there's millions of people interested in it and who are not very knowledgeable. At that time, it's likely that you should be selling it.
If you bought Bitcoin 5 years ago, sell it right now. If you haven't bought Bitcoin yet, do not buy it. That's my personal opinion. Latest news as well, Amazon cashierless stores are almost available. Probably going to be rolled out sometime in the new year. Then McKinsey, who's a consulting firm, just came out with a new article that said that they're worried about millennials and retirement. Millennials will most likely have to work 7 more years than their parents. That has to do with a couple things. One, because millennials are going to live longer. And two, what McKinsey says is that millennials are not going to see the same types of returns that our parents saw inside the United States, in Canada, or in real estate. What should millennials do in order to not be too fearful about the future?
Yeah, so that's absolutely right. They're saying that growth is not going to be the same in these markets. One is that interest rates have been so extraordinarily low, and it's really boosted the economy in a lot of ways, and people have been seeing super growth in their portfolios, and that's probably not going to last. Another thing is there's so much competition globally that the U.S. now is not just the world dominant player like they've been, for the last 100 years. You have different countries that are now posing as a strong economic player. So what should investors do? That's $1 million question.
There's something called a home bias. Home bias is that investors like to invest the majority of their money in their own country. So Americans like to invest in America and Canadians like to invest in Canada. What we're saying is if you want to get good returns, you have to look elsewhere. The good thing is that with technology nowadays and globalization, we have lots of options when it comes to investing. Yes, your traditional real estate, Canadian stocks and blue chip stocks and bonds from the United States, but also look to China, look to emerging markets, look to India, look to Europe in order to get that good return that you may not be getting from Canada and the United States anymore.
I mean, you want to just keep a diversified portfolio and, don't be afraid of different opportunities. There's so much access to information nowadays that if you're in, you can research companies in China that have strong growth forecasts. And if you're not into that thing, there's a lot of different portfolios that are already managed for you that have a lot of exposure to these different markets. So don't shy away from them.
Yeah, take a global approach. What is the difference between a tax-free savings account and an RRSP?
We talk about this a lot, but people really need to know this. The registered retirement savings plan, or the RRSP, is an account that's used to save for your retirement. But that account, you're basically, when you contribute to it, you get a tax break, because any sort of income that you make, any sort of contributions to that RRSP brings down the income that you made in that year. So people really like using the RRSP as a tool for their retirement that they're going to start pulling out when they're retired, 65 plus, but you're getting the tax benefits of a nice contribution to your savings account.
Let's say you're making $100,000 and you have $10,000 saved up. You put that into your RRSP. You should be getting a tax break of about 40%.
Yeah, marginal tax rate, 30-40%.
So you would be getting $4,000 off of your tax bill without having to invest your money. That is a tremendous way to make money on your investments.
investment, exactly. Yeah. The tax-free savings account, on the other hand, and this is a big difference, is you don't get that nice contribution back, or tax refund, we call it, up front when you contribute to it. However, you can pull out of the tax-free savings account at any time with no penalties. So the tax-free savings account is more, the money that you go in doesn't give you a refund, but anything that grows in the account, when you sell it, all the gains is tax-free. So think about it like you're investing in a tax-sheltered country or something like that, and you got to think of tax-free savings account as something used for a short to medium term goal. I mean, it can be used for retirement, but a lot of people have medium term goals like buying their next house or something like that, that you want to be able to withdraw the money without any sort of penalties, and the tax-free savings account is the one for you.
Difference between tax-free savings account and RRSP. RRSP gives you upfront tax benefits and deferred paying taxes on your investments.
You can't withdraw from it either.
And a tax-free savings account is more short to moderate term. You invest your money inside there, and anything that any growth that happens, you don't need to pay taxes on, which is a big
important
advantage.
Thing we have talked about is the RRSP. When you do end up withdrawing from it at retirement, you are going to be taxed on it. So
please know the difference.
Please know the difference. Do research. It's such an important tool.
Is it true if you make $100,000, you get 50% taxed?
That is the best question that we see. And everyone has a parent or cousin or brother or something that says, "Well, I make good money, $100,000 a year. The government takes half my money."
Biggest myth.
I'm actually going to tell people what they would pay if they made $100,000. So you'd pay $25,000 in tax, which is still a heavy amount of money.
I love paying taxes because when you pay taxes, I get to walk outside and not be scared. Nice roads, so I don't go into hit potholes and stuff. Free healthcare.
It's just when the government does silly things with the money. That's when I don't like paying taxes. But that's for another episode. How does the Canadian tax system work? Well, it works in a progressive tax system. So what does that mean? So for every additional dollar you make, it's worked as tiers. So the first $11,000 you make, there's no taxes on it. And as you keep making more money, there's different brackets that you're taxed on for that amount of money. It gets a little complicated. The
key is that you only get taxed on the money inside that bracket or bucket at that rate, right? So whether you make $1 million or you make $50,000, the first $11,000 is still taxed at 0%.
And the first $50,000 is the same for both people.
Exactly. Whether you make $1 million or $50,000, the first $50,000 is taxed at, what is it?
The first $50,000? Yeah, it depends, around 20% or so.
Whether you make $1 million or $50,000, the first $50,000 is still taxed at 20%.
Exactly.
Okay.
So if you want to know that there's a federal tax and a provincial tax, and you tally them up to see what you're actually paying, KPMG's got a great calculator. Check them out, see how much taxes you're paying on a year-to-year basis. So your average tax is the amount of taxes you paid over the course of the year, over or divided by your income. So that's basically the average tax that you paid over those tiers we're talking about. Marginal tax is where people think they're paying 50% of their income, when in fact it's not the case. Marginal is the tax you pay for every additional dollar you earn. So back to that person making $100,000 a year. That person, for every additional dollar he makes through an investment, through getting a raise, he's going to be paying 43% because at 100,000, that's where the tier is. Now, one thing is to keep in mind is for those of you that are making good money and are thinking about taking that raise, you want to not only think of it as like $5,000 or $10,000 more, but you want to know how much actually am I getting paid over the year by doing that extra amount of work. And if you're making $100,000 and you get a $10,000 bonus, you're essentially getting taxed $4,300 on it. So think to yourself, is $5,700 more that year going to be worth it to take that higher position?
Are mortgages tax deductible? Is the interest on mortgages tax deductible? And that's an interesting one because it depends. On your primary house, you don't have to pay taxes on the growth of it, so it's called your primary residence. You don't get a tax deduction on the mortgage there. But if you do buy a rental property and you take a mortgage, that mortgage is tax deductible. So key out there, if you do have a rental property, third, fourth property, whatever it is, that interest is tax deductible. Make sure you give that to your accountant. And the second big trick or myth that a lot of people don't take advantage of is something called the first-time home buyer plan. What that is you can take money from inside your RRSP, so before tax dollars, you don't have to pay any tax on that, up to $25,000 and use it as a down payment on your house. Please make sure that you take advantage of that. You do not know how many people do not take advantage of it. One thing about the first-time home buyer plan, a lot of people say, well, Anthony, I already bought a house, a while ago, I sold it. I can't take advantage of the first-time home buyer plan again. Actually, you can. The rules with the CRA is that if you have not owned a house in 5 years, you can reuse that first-time home buyer plan room.
It's good, something good to know.
Yeah, so a lot of our clients, owned a house in their early 20s, sold it, have been, renting for the past 5-7 years. They can then again use up to $25,000 to put it as a down payment.
Let's give them a summary. That was a lot of information to take in. Thank you for those that joined.